The dollar is getting walloped, and this is kind of a chart that I've had for a while, and something that I've talked about for a long time, which is there's probably a weak dollar cycle coming into play. Now, once again, it's not something that I'm going to fade going forwards, meaning I'm not going to just look at it raging higher, and go, okay, I need to start shorting the dollar. It's a let's look at the positioning. Okay, recently the positioning got way out of whack. If you look at the Swiss franc, if you look at the euro, if you look at the yen, like whatever it was, whatever currency was against the dollar, the positioning got out of whack. Which what that means is the smart money basically starts to short it. These are the commercial traders. These are the people in the know. So they start to come in and they're starting to short dollars as it's up here. And then on the other side, you've got the dumb money, which people like to think of as smart money, but it's really the dumb money, which is the hedge funds and the speculators. So the speculators are basically at that point getting extremely long. This is about in the beginning of January. Then the dollar starts to roll over really hard, and now it's just looking worse and worse. And I think that's something that we will continue to see in this cycle. And this long-term chart just kind of shows, hey, we do go through these dollar cycles. I have two of these. This is a more short-term one, but it also shows because there's two cycles for the dollar. One is on a 10-year time frame basically, and the other cycle is on a 6-7 year time frame. So you basically get these two different cycles, and they're both converging at the same time. Which usually, when you see two cycles converging, that's when you see these big moves to the downside. Now, speaking of big moves to the downside, that is one ugly. Have you guys seen Predator? There's one ugly motherfucker. I mean, that's nasty. I said a couple days ago I shared a weekly chart, and I was like, man, this is a really nasty candle. I don't know if we've seen a candle this bad. And this was a few days ago, besides the one in 2022. And now it looks like we're getting to that same point today, where the candle from 2022, if you could see on the left side of the chart, if you look at October 2022, it's basically around the time the market actually bottomed, and you go to today, these candles are pretty similar. So usually this extends a move to the downside. Now the dollar's got a lot of support around 100, so you could see a bounce around that 100 level. But once again, this is nasty. This looks like more like the beginning of a huge down move than just something that's going to end anytime soon. So Kashaps, what's your thought on the dollar today?
Sure. So I've been bearish on the dollar, I think, ever since Trump got elected. And that's just because usually when someone comes in with a mandate and Trump came in with a sweeping mandate, you just kind of get to steamroll over the process and just get your way. And I think that's what's happening. So we have seen that Trump is getting his way with quite a lot of things. Now, Elon Musk is doing the old Silicon Valley model of go fast and break something. So with Doge, everything that they are doing, I'm sure they're doing maybe 20-30% of it wrong, and they don't care because the other 70% they are making an impact. And if they break it, they'll just fix it. So it doesn't matter. So you kind of have this effect of the president and the new team, all the technocrats, they're all trying their best to shake things up. Now, when you shake things up, what happens? Firstly, you get the return of volatility. Secondly, because you're shaking things up, investors are getting out of their complacency. So until last year, it was a one-way trade. The trade was simple: buy US stocks, invest in the United States. Take your money out of your home country because your home country is terrible. Put it all in the Max 7. Put it all in the United States. Put it all in tech because that's the sector that's working. And now, because things are being shaken up, investors are like, hey, wait a minute, maybe I should be doing something else. Now, that's something else. Maybe, just get into US real estate, buy some steel mills or whatever it is. But that something else is taking money out of US capital markets. And instead of getting new liquidity into the US capital markets, it's taking money out. And the threat of tariffs. So when you put in tariffs, what do? You narrow the trade deficit, which means less dollars flow out of the country. Now, if less dollars flow out of the country, the less dollars get recycled back into the US as a capital asset. So let's say you trade with China and China takes those dollars and comes and buys US Treasury bonds. Now, because you don't trade as much with China, they buy less of US Treasury bonds. Now, because of that, US yields go up. So, simple relationships like this. So, what happens is if the trade deficit shrinks, then less capital comes into the United States. And what does it do? It pressures the dollar, it pressures all assets in the United States. Now, this is one phenomenon. The other phenomenon that's happening is there's a sector rotation going on. So, firstly, you have capital flow out of the US. And secondly, even within the US, you have capital flowing out of certain sectors which have been outperforming and into certain sectors which have been underperforming throughout the Fed rate hike cycle. So, you see the combination of these two things happening, and it is very, very hard to separate. Like, you see an outcome, it is hard to tell whether this outcome is being driven by sector rotation or by capital flows. And I think investors generally are getting confused because they are not able to tell these two apart. So when the market tanks, they think, oh, it's because of this, it's because of that, where in reality it could be completely because of the other thing. So Nasdaq is down 10% from its highs, and everyone is like, oh, it's a bad market, it's a bad market. But you talk to every active investor and they are all having a good year. So that doesn't happen in a bear market. When you have a bear market, almost pretty much all investors end up having to either fight for their lives and make a little gain, or they end up losing money. So here, that's not what you see is happening. Here you're seeing the index kind of going lower, and almost everyone in the active space is, in fact, forget about having a good year. I think everyone's had an excellent start to the year. It's the kind of year where, if you close your accounts and hit the beach for the rest of the year, you still make your P&L. And that's the kind of returns everyone has made. So
Wait,
even
so
though the,
let's break that down
yeah,
for 1 second, because that would not be true, because you and me, yes, sure, but like most of these people in the United States, like you've been pounding the table on this, I've been pounding the table on this over and over again, which is like, hey, look at some of these other trends that are going on around the world right now. Let's start to look at going to China, going to, you talked about China a lot too, as have I. Let's get into Latin America. Let's look at all of these other areas that are having this massive outperformance that really do well when the dollar weakens. And nobody's been doing that. I see people over and over again. This has been a really tough year. It's been really hard. And it's like, yeah, that's true if you're just investing in the United States, or if you're just trying to stock pick in the United States. The one thing that I always think back to, and it's funny, I was talking to Joe, the guy who wrote the book on options, Joe Duarte. He was on the show a few weeks ago, and we were just talking about it. And I was like, everything you really needed to know about markets, you kind of learn in Reminiscence of a Stock Operator. Like, if you go back to it and just go, okay, when there's a bull market, all stocks move up, mostly, like almost all stocks move up, and in a bear market almost all stocks move down. And that's subject because of the business cycle. And that's the old Austrian economist Mises basically came up with it, talking about money supply moving up or money supply tightening, and basically it lifts all ships. And that's true. And so, like, when you go somewhere and you see, okay, well, the United States is in this sort of trouble, and you're sitting there and you're trying to stock pick inside of it, and you're having a really rough time, like, it's a no shit, you're having a rough time. It makes a lot of sense you're having a rough time, because not many of these stocks are moving up. You have to be very, very tactical. You'd have to be amazing to predict it. Whereas, a couple years ago, and this because you and I love to trade these type of environments. Whereas the other type of traders, they love to trade like the environments that are going straight up every single day. And they're like, this is perfect. Look how smart I am. I could basically turn around and throw a dart at a wall, and I made money. And yeah, those are great. And those are times to really step on the gas and make some more money. But just saying, like, so many people are kind of stuck in the United States at the moment. And there's nothing wrong with that if you're picking the right things. Like, you and I have talked about gold miners in the United States, Canada. That's a good area. Obviously, GDX is, I think, one of the leading sectors in the United States this year, up 20% almost. Gold, silver have done well. So there are places inside of the United States to buy, but you really need to be tactical with those sectors if you do. And you have to not be so stuck in, hey, I have to invest in the United States because it would be un-American to do something else. The un-American thing is to not make money. And as an American, I'm trying to just make money, and as a person, I'm just trying to make money for me and my clients, and that's got to be the biggest idea. Some years we're heavily involved in United States stocks, and that's been the place to be for 10 years or more. And so, like, yes, obviously, there's times where you want to start investing heavily in the United States, but there's also times where you go, okay, the dollar's really getting hit here. There's something going on globally. Gold is doing really well. Copper is doing really well, which is a good sign of what's going to happen to international stocks. I want to start buying some of these other things in these other areas, and I think you'll be a lot happier, you'll outperform, and it'll be a lot smoother ride than trying to buy something that's getting beat up, falling below the 200-day. It's funny too if you look at it. Every day I kind of just glance at the market and just kind of take a look at what's going on inside of it and under the surface, and you're like, okay, well, United States down, 1 or 2%. China's up 1 or 2%, like, or like same with gold. Like, gold is also really, really outperforming the S&P 500. I showed people that chart the other week, and people got all types of feelings about it. Oh my God, you're late to the gold trade and all this stuff. And it's like, no, no, man. I'm just telling you the trend's been up in gold, and I'm telling you now it's starting to outperform the S&P 500, and that could be because gold goes flat and the S&P goes down. But that's also brings me to another point, which is you've been mentioning this idea of the United States being under some pressure for a while. And I know you've gotten some pushback on that, even from myself. So, like, why don't you talk about that a little bit? You wrote that paper, The Minsky Moment. So let's go into that a little bit, and then we'll get on the rest of those slides.
Sure. So the Minsky moment, I wrote that because I was seeing so many signs of speculation. So here's the thing. So when you're trading price action, you are trading the price action that you see in front of the screen, not what you think it should be. You're not arguing with the market that, hey, this chart looks like this and it should look like this in reality. But when you zoom out and you're trying to kind of build a business as well, so what do you look at? You look past what you can see, you look at historical trends, because really history is the only guide that helps you with everything. And history, looking at analogies and what's happened in the past, how things are shaping up, that helps you think in a new way. So I wrote the Minsky moment because I saw a lot of parallels with the roaring 20s, and I saw a lot of the crazy behavior just get explained away because how does it matter, the price is going up. And I heard this so often that I thought, wait a minute, why is no one thinking past the next moment? And that's because when you're caught up in that bubble, when you're caught up in that frenzy, it is very difficult to see past, forget about the next week. You can't even see past the next day. The market is up today. I don't care if the name of Bitcoin, which is an obvious joke, it is going up, so I'm buying it. And this was the kind of behavior that got normalized. And then you saw so many people just get hung up on call option flows. They're like, there's a gamma wall at this level, so I'm going to buy these calls. And it's that behavior got so crazy. And I saw so many accounts, they were like, you only need $200,000 to make this much in income selling options. And I was like, we have seen all this before and we know how it ends. And everyone who's been in the finance profession knows how it ends. And they are still looking at it and going, yeah, that's normal. And why do we all look at it and go, that's normal? It's because we have seen how this plays out, we have seen how this ends. And so I thought, yes, this is the setup for the Minsky moment. So the Minsky moment, it was coined by an economist. So what he referred to was, he started with the business cycle when an economy is coming out of a recession. So the Austrian economists have much more elegant theories, but Hyman Minsky, he actually has a good framework for non-economists to understand business cycles. So what he says is, you start with an economy that's coming out of recession. Banks are gun shy, they don't want to lend. And so you have this phase where there is a genuine economic recovery driven by productivity growth, just by people working hard and saving and investing and compounding their wealth. Then you get to a point in the cycle where the banks are okay to lend to something that's pretty safe. So, a working capital loan, yeah, you might get it. You want to remodel your kitchen and go on a cruise and buy a flat screen TV? No, you won't. So the banks lend, and slowly the economy starts to pick up. Then they get more confident and they start lending against assets, they start lending against more speculative things. And eventually it gets to a point where people are borrowing money to buy assets, and they are only going to be able to service the loan. Not from, it's not like you buy a tractor, you lease it out to a farm, and you make your money, your lease payment, and then you pay the bank. It's like you buy a tractor, you sit it idle, and you hope someone buys it from you for a greater price so that you can repay a bank loan. So you get to the speculative phase where that's what he calls the Ponzi phase, where people are borrowing money to buy assets, and there is no way they can service those loans unless a greater fool comes along to buy those assets. Now, we saw a lot of this behavior. So the Interactive Brokers CEO, so Interactive Brokers, after Schwab Fidelity, is one of the top brokers in the United States, and the CEO came out and said something like 50% of stock trading on a platform is just max 7. And then he said margin debt on a platform just hit a new all-time high. And as he was saying, so this was in December, this was at a Goldman Sachs conference, and as he was saying all this, the media was focusing on Fatcoin, cryptocurrencies, or Palantir, like all these things. They were not even paying attention to what the CEO of a brokerage firm was saying at a Goldman Sachs conference. This was not some university speech, in Pittsburgh or somewhere. It was at a Goldman Sachs conference. He's coming out and saying there are all these warning signs. In fact, he was scared. In fact, he made a statement where he said, I hope this bubble doesn't burst too soon, because if it does, then we'll be saddled with losses. Now, that's a,
Wow.
yeah, and still people didn't care. And then you had the inauguration, and then you had meme coins all over again. And then you had Javier Milei. He came out with his own meme coin and rug pulled the crypto community. And I think there was another meme coin launch, Kanye West or something. I'm not sure. Someone launched a meme coin like a couple of weeks back. And it's just been, all these crazy behaviors have been building up. And you see all these people taking out credit card debt, taking out personal loans, and buying cryptocurrencies with it. And I'm like, this doesn't make any sense. And I think so. We have come to a point where it's gotten to peak insanity, and now people are coming to their senses. So there's this Charles Kindleberger quote where he says, men go mad in crowds, but only come to their senses slowly and one by one. And I think that's pretty much what's happening here.
And let's give people context. That's the book, The Madness of Crowds, right?
Yeah.
Yeah. Okay. So the book is called The Madness of Crowds by Charles McKay. And you guys should definitely check that one out. I'm also trying to do more with giving people more resources. So if you guys do see the Substack channel starting to have a lot more links at the bottom, that's part of what I'm trying to do now going forward. Have, if I'm talking about something and you guys want to learn more about trend following, I'll send you to a trend following thing, some book, some resource to learn from, and vice versa for fundamental investors that I like or whatever. If I'm talking about Bruce Kovner, I'll send you that direction as well, whatever it is. So yeah, kind of looking at this. Let's go through the next slide because we brought some good ones for you guys today, and there's just so much going on. So looking at the dollar yen, and so you talked about this, and this was back in, is that peak in August 24? Yes. So that was the vol I want to call it Volmageddon, but there's like 50 names for the for vol stuff these days, so I don't remember which one this one was. But once again, August 2024, there was a huge move in volatility. The VIX spiked all the way over 50 very quickly, and everybody just decided that everything was fine, and the market just continued to move higher, and everybody kind of forgot about it. Now, once again, I'm a trend follower. I'm going to be riding a trend, even though I'm not a fan of the S&P 500. I never really trade it. I will be long other sectors and be fine with it. But at the same time, when you look at this and you go, okay, something was kind of happening here, something big happened, and it was a fundamental shift in the market. I think people will go back to this point and kind of go, hey, this was a big deal, and nobody really cared about it. So, Kashyap, what are you looking at here, and what are you thinking about anything I just said?
So I think everyone in the world should be watching the yen at this point, and that's just because this is a trend that has been in motion. So this is a weekly chart, but you go back to a monthly, it's the same. So this is a trend that has been in motion for a long time. And when that kind of trend ends, and so Japan, think of Japan as the supplier of global capital. Just as the United States is the absorber of global capital, Japan is a supplier of global capital. So capital moves out of Japan and it funds everything. So lower yen, which is the USD JPY going higher, which is what you see in this chart, means more of Japanese liquidity floods the international market. It means banks are happy to lend, and thus because they put out loans in yen, and by the time those loans are repaid, the yen is worth 20-30% less, which means the borrowers can easily afford to repay those loans. So what happens is, because the currency keeps depreciating, people take more and more loans in the Japanese yen and they take it out of the country. Now, you can't do this in most countries, and that's because, like, let's say India has a chart which looks like this, or the Nigerian currency, which is called the Naira, which is like gone from 400 to 1600 or something. If you borrow in Indian rupees or the Naira, you have to pretty much invest it only within the local economy, because there are a lot of rules involved in getting your currency out. With Japan, there are no such capital controls. So you can borrow in yen, you can take it out, and there are no restrictions against it. So what happens is people started borrowing in yen. And the more people borrowed in yen and then sold the yen to buy other currencies, the more the yen depreciated, which means it's a virtuous cycle. So it got to a point where Japan is facing something like 3% inflation, something like 8% inflation when it comes to food, and people are panicking. They are like, is a currency really going to go to 400, 800? So if you go back to history, there was a point in the 60s or 70s where the Japanese yen was at 400 to the dollar. And then the economy industrialized, they started exporting, the economy became the number two economy in the world. And in fact, you got to a point in the 80s where everyone thought this tiny island in the Pacific is going to overtake the United States as the world's largest economy. So there were books about how everyone in the United States should speak Japanese and learn their customs and all that. So you got to a point where the yen really massively depreciated start in these last 10 years, and everyone took out loans. And then the new governor, initially he was very skeptical about ending this easy money policy, but as he saw inflation take hold, as he saw the unrest going on, he decided, okay, let's not have negative interest rates anymore. So Japan was the last economy in the world to end the policy of negative interest rates. So they went from minus 0.1% to 0.1%, which was like a big shift. And now they have changed the 0.1% interest rate to 0.25%. So now my inflation is at 3%, food inflation is at 8%. That doesn't matter. Like what matters is from zero point 0.1 to 0.25, it's a big shift. So borrowing in yen is no longer a free lunch. So what happens? The banks stop lending. So let's look at the next chart, which is the chart of the Japanese banks, which tells the story clearly. So the banks were lending, they were making a big load of money, and you can see this chart where it looks like a parabolic move, but this is a monthly chart, so it's not exactly parabolic, but you can clearly see how well Japanese banks have been doing. And that's just because the banks do well in an expansionary cycle and they do terribly during a recessionary cycle. And the Japanese banks have been having an excellent expansionary cycle for so long. So when this ends is when you will see global liquidity dry up. Now, it's not going to happen precisely this way, because this is kind of a slow moving disaster. It's the iceberg that you see coming at your ship. So, whenever you can see a problem, everyone's going to act to solve the problem. So, what happens? That's something we do not know. Like, will the central banks coordinate and say, okay, let's appreciate the yen? And there were precedences to this. So, in the 80s, they did that for the United States with the Plaza Accord and the Paris Accord. So, they played with the currencies. So, maybe they do something similar, or maybe those loans just get repaid, or who knows, maybe Japan, goes back to negative interest rates, let their currency go to 400, and they don't care about inflation. So that's possible, because we think hyperinflation cannot happen in a civilized society, but You go back to the period between World War One and World War Two, people thought that was the end of history, that there'll be no more great wars, there'll be no more fights, there'll be no more big historic events, and history just proved them wrong. So we think a big industrialized economy cannot hyperinflate, but it can. It all depends on the market forces, and that's why 80s, 90s used to have this term called the bond vigilantes, which we don't even hear about anymore. The bond vigilantes were the people who would take down the value of a country's bonds if they printed too much money or got into too much debt. Now, with Japan, the bond vigilantes are back. In fact, I think even with the United States, the bond vigilantes are back. So, how this plays out, I cannot exactly tell you this is what is going to happen. I can just tell you this is how it looks, and everything depends on what the next step the central banks and governments take. But this is the chart that everyone should be watching.
No, I love this because it's once again it's something that's always important in my macro research that I always go to, and I tell people this all the time, is if you want to see what's going to happen in the United States, look at Japan. They are so interconnected at this point that if Japan starts to go into a full downtrend and crash, the United States will go into a full downtrend and crash. These things are so interconnected from their bond market, investing in each other's stocks and each other's bonds, all of these things. And it's interesting you bring up this point about the bond vigilantes, because for me, I was thinking the same thing, but I never put the two together because I was more thinking about the fact that China has become, bond vigilantes were funds and different things back in the day, different people. But now it's countries. Countries are the bond vigilantes. China is a bond vigilante, selling bonds, buying gold. Russia is a bond vigilante. So it's very interesting because now you're talking about a lot more money. And obviously the United States has a lot more money, but these countries have a lot more money. They continue to buy gold at very, very heavy levels, and it just keeps ticking up over time. The physical deliveries look insane, and people keep attributing that to like traders or funds or something. It's like, no trader is sitting there going, I'm taking physical delivery of this. No trader wants to do that. This is a coordinated thing, and I think it's partially against the United States. Now that's just my conspiracy hat kind of being on. So once again, I'm not saying this is financial advice. Do exactly what I'm saying. I'm saying that the game's kind of changed, and it's the reason why we see gold just kind of going up and outperforming everything, and more buyers just kind of coming into it. And that doesn't mean that it's an environment that gold doesn't like. This is a great environment for gold. It makes perfect sense that gold is going up. However, the rest of these countries also see that environment, and they're also investing heavily into gold and selling bonds heavily. And it's something that I think traders should be doing as well. Everybody loves to talk about this great bottom that's happening in the bond market that you can't even see yet. That's the thing about that cracks me up every time, is like there is no breakout, there's no reversal. There was one last year that looked like it could start. I think it was in summer, right around a Fed meeting. We got basically long bonds across the curve, had a good trade in it for a minute, and then it fell right back and went to a short once again. And now it's still a short for most things across the curve, except for if you're in the long part of the curve. And I know most traders who are on here are going to be in the long part of the curve because you don't have access to the other ones. There's just so much going on here. This is such an in-depth topic. So I'm glad that Kashop brought that up. I think this should be on everybody's radar. I think this chart should be on everybody's watch list. So looking at this, though, so we're talking about gold, and we're seeing this move, and this move's just kind of continued. It's in a great uptrend. So many people, right at the beginning of this, I put out a paper which was basically talking about bubbles. And I talked about a guy that I just knew over the years. He wasn't like a close friend of mine or anything. I just knew him from my BMX days, and he was just a person I knew. Anyways, he was scary as hell. He's almost 7 feet tall. When Bitcoin was at the peak of its bubble in 20, and giving you a little context, this guy was, there's a picture of this guy that's legendary that goes around to everybody has seen it who's into either heavy metal or BMX riding, which is him standing in the middle of a Slayer concert with his arms straight up, and just like nobody wants to even mess with this dude. That's how scary this dude is. So 2017 happens. We're in the middle of the bubble. he basically calls me and he's like, "Hey, man, Litecoin's going to be worth more than Bitcoin." I say, "That's probably mathematically impossible." And I try to give him a reason. He loses his mind. And he's like, "I'm going to fucking come to your house. I'm going to kill you." And it was pretty scary because, this dude's a huge dude and he's telling me he's going to come kill me. Anyways, I remember looking at my son at that point and being like, "Hey, I think it's time we start selling this Bitcoin." And it was funny because for me, I'm very systematic and it's very rare that I do things like that. Um, but that's one time where it happened. But what I'm bringing this up is people see the gold market and they're like, it's the same thing. It's a bubble. It's like, this is not a bubble. That is a very sustainable uptrend that could last for many, many years. It will peak out, it will consolidate. Look at the one from 2000 all the way to 2011. It peaked out, it consolidated, it pulled back. It's not going to be a perfect uptrend because there's no such thing as that, but it is sustainable. It's not breaking parabolically. But the next thing that you see at the bottom, and people always ask me about this, so I'm just bringing this chart up to show everybody exactly what I mean when I say these things. Gold leads the move in the commodity cycle. You will always see gold break out first, making new 52-week highs. That happened in 2024. So basically, beginning of 2024, you see the new 52-week high, and then it keeps trending higher. Now, usually 10 to 14 months later, we start to see other things move. Copper was the first one to start taking a move. So it already made a new 52-week high. That was last year in the beginning, or basically the middle of the year. And it had a nice big move. Now it's trying to break those levels once again. I think it can. Let's see how it reacts up here now that it's up very high. It had a 5% update the other day. We're seeing money flowing internationally. All reasons to be very bullish on copper. And then if we go to oil at the bottom, looks like trash. Now, once again, thing has faked me out as well. It broke out for literally 5 seconds, reversed lower. Now it's been chopping around those lows. There's another thing to think about here, though. If you look at the energy sector like XLE, you go to 2020. The commodities started ripping basically out of that bottom in March 2020. Whether you look at softs, grains, whatever, most of them kind of bottomed around March, April 2020. Gold obviously bottomed right at the bottom in March 2020 and ripped higher first. And then it took a while for oil to really catch up. Now, gold's first move that actually gave that signal was in May 2019. So May 2019, we get that first signal from gold, and then oil gave its buy signal going into the end of 2020. So 10 to 14 months later. Copper was already moving, bottoming around March, April 2020. So once again, I think oil will catch up. I know this question comes up a bunch, but I also think it's very smart to wait for that to hit a new 52-week high. Wait for your buy signal. And not to mention, don't be afraid to take the buy signal. There's sometimes you're going to get stopped, like that one trade we got. It went on, it made a couple bucks, it reversed. It was basically a flat trade. Who cares? It's going to happen in your portfolio. But when this thing actually starts to move and really break those $85 levels, I think that's when we really see this thing start to move. And the next thing I wanted to bring up really quick, which was gold to the S&P 500. This chart made a lot of people feel some things, and I'm sorry if I hurt your feelings with this chart, but it's just the truth. Which is gold is outperforming the S&P 500. Now, some people look at this and go, "Man, you're super bullish gold," and I am. I've had this position for a long time, going back to 2023 in gold and 2024 in silver. But once again, this is a band squeeze breakout. We're hitting new 52-week highs against the S&P 500, and look how the S&P 500 performed in those years. So the S&P 500 didn't do very well in the 2000s. Gold did. Financials did. A lot of these reflationary style sectors did do well, but what didn't do well, what did terribly? Technology. I'm not saying technology is all bad. I'm just saying it got ahead of itself. If you can look at the AI trade and think that everything's just fine with the AI trade and it's just going to go forever and ever and ever, that's just not how trading works. Things go in cycles. AI really moved. It got a great move. It will probably really move once again, probably soon. But right now, today, I'd say start to really pay attention to what the market's telling you here, that international stocks are doing well, gold is doing well, some of the commodities are doing well, and this will continue to pick up. So, Kashop, what are you thinking about, gold right now? Do you have anything that you're really looking at that you're saying, "Hey, this is great about gold"? What do you think about silver? Feel free to go anywhere you want.
Sure. So before we get on to gold, I just want to add a quick point on oil. So the problem with oil is, I mean, we all use WTI as a benchmark. We don't look at Brent. We don't look at other grades. And the problem with WTI right now is two things. So one, Trump comes out and says, "Drill, baby, drill." So everyone's like, "Oh, US is going to increase its production," and everyone remembers what happened in 2014. So you had shale having a massive boom starting from 2006, 7, all the way to 2014. So US went from a net importer to kind of neutral. In fact, it overtook Saudi Arabia to become the biggest oil producer in the world at one point. So you had that dynamic. And so when Trump comes and says, "Drill, baby, drill," everyone has this muscle memory that they're like, "Oh, yeah, we had shale, we had all these offshore wells, and we are just going to go back to that era where the US is going to become a massive producer." So that's one concern. The other concern is the Chinese tariffs. So people underestimate the impact of the tariffs. So the problem with US oil is that the grade that you produce in the United States doesn't get refined in the United States. So the grade that the US produces gets refined in China, and the grade that Venezuela, Canada, all these other countries produce, that gets refined in the US. So now when you have the Chinese tariffs go in, what happens is US oil becomes, that is your WTI, becomes less competitive in the world stage. And because of that, so the oil price is basically pricing in the 10% tariff. So that's why it's weak. And the drill baby drill thing, so you have Chevron come out and say they're cutting capex. You have a lot of other companies saying they're going to be very cautious about their capex spending. In fact, if you look at the inventory of drilled but uncompleted wells, it peaked in June 2020. So a drill but uncompleted well is like the company drills the oil well, so it's like they have the inventory. Whenever they want, they can just get the oil out, but they choose not to do that. So they just wait for higher prices to get the oil to flow. So the inventory of those wells, that's been dropping since June 2020. So although Trump does say drill baby drill, the producers are not responding. And as long as there's the China tariffs, WTA is not really going to break out, because other grades of crude might, and you will not see that in the chart. So for oil, what you need to do is you have to go look at the chart of the refiners. You have to go look at the profitability of the refiners, the US refiners, and there are just like four of those. So you go look at those, that really tells you what's happening in the oil industry. And with oil, the problem is the market is so connected that if you're just looking at one part and not seeing the other, then you're missing the forest for the trees. And everyone who is so hung up on why is oil not moving, we are in an inflationary environment, is kind of missing the forest for the trees. So now you asked me about gold, and I think so it's a bold prediction to give out, considering gold's moved from something like $1,800 in October 2023 to 2,900 now. But I think gold doesn't consolidate but goes straight up for the next few months. And the reason for that is the Bank of England, their vaults are empty. And that's not even been acknowledged as news yet. So once that comes out, I think we'll start to see a little bit of gold fever kicking in. And mm, looking at how it has been in the past when the gold fever takes over, in fact, there's a saying, there's no fever like gold fever. So I think we get a tremendous run, because everyone sees inflation coming. Everyone remembers holding those little silver coins, gold coins in their hand and thinking, this is somehow going to be super valuable in the future. I mean, like, I'm sure all the kids born in the 60s and 70s have had that experience, and they have passed that experience down. And if you look at Asia, you look at other parts of the world, it's like super in our culture. So you see the gold price going up, and you see all these events happening. And more importantly, you see the dollar tanking. I think gold just keeps running and keeps surprising everyone without pulling back. Now, of course, I could be wrong there, but I'm just putting this out because I think if you look at the price action and say, oh, this chart is all the way up here, I'm going to wait for a correction, wait for a dip to get in, you may not get that dip. That's pretty much the only point. I'm not saying that it's going to go from 2,900 to 10,000 an ounce or some crazy figure. I mean, that might happen, but the point is, I don't think you should be waiting for a dip if you don't have an entry into gold or the miners. So I have pretty much whatever the prices, I'm continuing to accumulate the miners because it's great value. And of course, I always buy physical gold. I've been buying it since 2014. With silver, I'm not so sure. And the reason for that is silver is kind of an industrial metal. Like we might think, yes, it has monetary properties because it used to have those monetary properties. And for a small section of the gold loving populace, it does, but the vast majority of gold investors, they don't want to bother with silver. I am talking about the people who take delivery of the 400-ounce London Good Delivery bars. They are not the kind of folks who want to be bothered with silver. So it's the same reason rhodium, platinum, palladium, all the other precious metals, they are not taking off for the same reason, because right now everyone is focused on gold. Now, as the rally broadens out, maybe once gold hits 4,000 or $5,000 an ounce, you will see a frenzy in all the other precious metals. In fact, I remember there was a point where people were buying copper rounds because, gold, silver,
Yep.
copper. Yeah.
Platinum rounds were everywhere back then too, like it's so I think it's an interesting idea here, which is so physical wise, let's just talk physical gold to actually trading gold. Physical wise, I buy gold heavily. And for that reason that you just laid out there, it's a monetary metal. You can look at the premium and see that premium has continued to be built in. So that premium over time continues to go higher. We continue to see that outperformance to a lot of assets, including the S&P 500 at times in gold. But you don't see that much in silver except for at very specific times. And when those specific times happen, it really takes off. And so what I think is happening here is, think of this cycle that we're looking at right here of gold in the S&P 500. When did we really see silver take out? That was later in the cycle, getting into 2007, 2009. So I think that's more when we're going to see that.
Yeah, I completely agree. Is there any
But I
other
do
chart?
think one more thing though. I do think it's coming soon. I think it's coming sooner than you do. And I'll give you my reason. One is we're starting to see that we're at that same level that we usually see this big move happen. Two is we're starting to see some of the miners really do well. The good ones that are actually have some good management, like those are actually starting to do very well. Things like NEM and stuff. Like once again, I always tell people, like, if you're going to buy the ETFs like me, great. But I also know I'm investing in some terrible companies inside of that ETF. If you're a stock picker and you want to grab AEM and different names, that's a great idea. I'd continue to grab some of those names and just see how those continue to pick up. But once again, I think we're seeing the rally broaden into other areas. One of those being the junior miners, the silver miners, and possibly, like, if you look at SILJ, I think Sam did some research on it the other day, so I'm not sure if I'm saying this right, but I know it was either SIL or SILJ is actually outperforming everything. It's up like 43% over the last year, whereas the rest of them are up, 20 or 30. So I see money flowing into the area, and silver is actually year to date hand in hand with gold. But for me to get very bullish on silver, I want to see that outperformance really continue. So right now we're just kind of both speculating. Kashop has an idea of maybe once we get to 4,000. I have the idea that it could happen now, but what I want to see is it actually happen. If it actually happens, then I'd get even more bullish on it. But we are seeing it break out to a new high. It is trying to sustain it. If we get a nice closing high this week, I'd be a little bit more bullish on it in the short term. I do like the idea of owning, long-term call options in something like silver, because at some point, both of us will be right. It is going to explode. If this cycle continues the way it is, it will move higher. I just don't know the win in that equation.
So the one good news for ETF buyers is you don't have to buy the GDX and GDXJ anymore. So Sprott has come out with an actively managed gold and silver ETF. The ticker symbol is GBUG. So they have I mean, some of those stocks are kind of overvalued. I'm just taking a look at the ETF construction. Some of those stocks are overvalued, but looking at how GDX is constructed, the way they had so much weightage for Newmont and Barrick, this ETF doesn't have any of that mess, and it's not market cap weighted. So that's a good thing. So if you're looking for an alternative and you don't really want to pick your own stocks, then take a look at GBUG. And likewise, if you are looking at GLD and SLV and you want to add those ETFs, take a look at the Sprott product. So sometimes what happens is because they are closed-ended funds, they trade at a discount to NAV. So instead of paying a premium to buy gold or buying it without a premium, you actually get more gold for your buck when you buy it at a discount. And of course, the discount can last a long time, but you remember the 2017 Bitcoin cycle. So there was this one, not an ETF, but a trust called GBTC, which used to hold Bitcoin and they had their shares trading on OTC. There was a time when demand for Bitcoin was
Wait.
so
Sorry to cut
insane.
you off, but it. So this is how bad I am at this stuff because I'm always for Bitcoin. I'm in futures or spot. It's gone already.
Yeah.
So GBTC is gone. Okay, thank you. Sorry, that's surprising.
So GBTC, they used to trade at a 30% premium to NAV when Bitcoin was taking off. Now that's insane. Now I'm not saying when you buy these closed-ended funds you will get those kind of moments, but if you do, then that's really great, right? So always try to buy at a discount to NAV. And I mean, you're fine if you're buying options, then you should definitely stick to GLD and SLV because the more liquid the ETF, the better the option prices. But if you're just buying something as a long-term trade, then you could buy these closed-ended funds at a discount to NAV and hold them and hope that they get a premium to NAV. So uranium investors have been very successful in doing this. So there was a time when there was a product called Uranium Participation Corp, which was a company, and they used to buy physical inventory of uranium and store it. Then Sprott took that over, made it into kind of an ETF, and that ETF started to trade at a premium to NAV. So Sprott, because they have a big retail brokerage business, they know how to market, they know how to drum up business for these ETFs. So you just take advantage of a marketing hype cycle along with the commodity cycle. Sorry, what were you saying about the GBTC? That
So
it's
no, I
gone?
was just saying that I didn't know it was gone already. Like I don't pay much attention to the Bitcoin ETFs at all, so
Right.
I just didn't know it was already out of the system. And I know there's other ones now, but it's just kind of interesting to see that.
Yeah, the
So
funny thing is that Grayscale sued the SEC to get these Bitcoin ETFs listed, and once the Bitcoin ETFs got listed, no one wanted Grayscale anymore. So they kind of kill their own product.
So getting to the silver to gold ratio. So guys, sorry, I don't have multiple screens in the new studio just yet, so I couldn't see what slide is next. But I was talking about the silver to gold ratio hitting a specific level. I was talking about silver making a new closing high. So basically, on the bottom of the bottom chart is basically just silver futures. If we start to see that get a new closing high this week, I would say we're probably starting a new leg higher. And also, we're sitting at that level that we've seen silver start to make big moves off of a couple times now. Actually, 3 times, so possibly 4 times. It doesn't always work that way. This technical analysis is just like any type of analysis where it's not perfect, but it gives us a good view of what could happen. So I think that if we continue to look at this and see that the silver to gold ratio continues to get tighter and tighter, it's squeezing, and then if we kind of get a good move higher here, I think that could be more sustainable. But either way, short term, you probably have a good move in silver here. Long term, I'm not sure just yet, but short term, I think it looks really good so far. Let me see what we got next. So, perfect way to end this chat. Let's talk about China. Let's talk about what we have kind of going on here with this rotation. The beginning of this, if you go back to the first slide that we had in this deck, it's the dollar. And so the dollar is very important, obviously. It's the most important macro signal that I think I use, and it doesn't mean it's going up and the market's crashing, it's going down and the market's doing great. It means that money can flow different directions at different times for different reasons. So once I see a weak dollar or positioning kind of getting very lopsided in the dollar, I want to see what's going on with international stocks and start to see if money's flowing in those directions. Then now, if we're seeing a weak dollar, money's flowing internationally, I want to own those things. I want to be long those things. I want to be long the currencies against them, which is how our portfolio is positioned right now. Also, things like gold and silver obviously benefit from a weaker dollar, usually. So, Kashop, anything you want to end on with China? Because I know you were talking about China a lot as well. What do you think people should be looking at inside of this ETF? Like, there's stocks, there's names that you know more about than I do. I'm basically kind of invested in the FXI and the KWeb at the moment. So, what are you looking at inside of China?
So I just have two Chinese stocks. One is Pinduoduo, which is PDD Holdings, and the other is JD.com. So that's it. That's the extent of my China exposure. And in China's case, because I don't really have great knowledge of the country, I would say you should pick the ETFs. And even if you do just pick the ETFs, you'll do really well. The reason is if you go back to March 2009, why was that the buying point for the S&P 500 or the Nasdaq or pretty much anything US related? It's because the Fed did QE. And right now, what we are seeing is China had a huge deflationary crash and they have started doing QE. Now they started doing something more than just QE, and that is earlier they were trying to kind of stifle their homegrown giants. So Alibaba, they had a financial wing called Ant Financial, and when they were about to go to IPO, the Chinese government said no, we will not let you IPO. And then they kind of implemented policies to kill their tech, gaming, and education sector. So they said, all these for profit companies, we don't want them anymore. So they did a lot of things to hurt the stock market over time, which they have not just stopped doing, they have reversed it. And they're doing QE on top of it. And global investors hate China. They've been underallocated. And when they see DeepSeek come out, when they see Quen come out, they're like, maybe we misjudged it. So I read a study which showed that something like $450 billion has moved out of US tech and into Chinese tech. Now that's a big shift in global capital. And the capital allocators, they all think in a herd. If you see that guy do it, you do it. Because if you don't do it and then you get asked, why are you not in Alibaba, which is up 80% this year, you don't have an answer. So you have to say, yes, yes, I was a little late, but I'm buying it now. So you're going to see this big capital shift. And I think this is the point where it becomes sustainable for China. And that's just because you take a look at the valuations of some of these stocks. So you can buy Chinese banks at zero point 0.2, 0.3x book value. You can buy these tech companies at a 10x PE, and they are growing earnings at 20-30%. So the price to earnings growth ratio is insane. It's just surprising how cheap China is. And the only analogy is if you look at Eastern Europe in the 90s, when the market was just opening up, how cheap Eastern Europe was, or if you look at South America when that market was opening up, how cheap it was. China is that cheap now. So I think we have a long tailwind, and you'll be fine if you just buy the ETF.
And let's also specify this for people who are going to just pull up the ETF and go, "What are you talking about, Kashop?" So you're talking about the actual indexes for these countries, right? So that's what you're looking at. So going back to the beginning of it, so make sure you guys, if you're looking at it, go to the actual ETFs for the countries he's talking about: Eastern Europe, Eastern European countries, African countries, and so on. See those open up, and that's what we're talking about here. Don't just look at the ETFs. So, all right, guys. Thanks for joining us. We had 1,250 people today. So 1,250
Wow.
today. So thank you guys for joining us. Feel free to write us any questions. Leave the questions in the, if you're on Twitter, leave them under the videos. We'll try to get back to you guys. We can also bring up your questions next week, whatever you guys want to do. Also, Kashop, I keep forgetting this really quickly. Mark has actually asked me a bunch of times. Sorry, guys, I am forgetful. About potash stocks, and I said I'll ask Kashop. So do you have any ideas about any of these things, fertilizer, potash stocks, anything you're looking at today?
I love them, but the problem is they are Canadian companies. So I don't know what's going to happen when they export their potash into the United States. So
No, good
that's the
point.
big question mark. Yeah. Otherwise, I think they look fantastic, but with the trade war, it's a question mark.
Yeah, and it's a lot of it is right now, and that's kind of where we're seeing all this volatility. At the very least, most of these other countries, like we kind of are, I think you're seeing this flood to other countries also because you're seeing the uncertainty in the United States and you're seeing more certainty in other areas. And one thing we know about markets over everything else is markets hate uncertainty. And if they hate uncertainty, people are going to look for other places where their capital is going to be protected better. Things like gold obviously is probably the most certain place people can put their money right now, which is what's driving this massive uptrend. So all right, guys, thank you guys for joining us. We're on every Friday at 11 a.m. Eastern time. This is the Holy Macro Show with Jason and Kashop. I just talked about myself in third person. That's weird. All right, guys, we'll see you later.
Bye, everyone. Have a great weekend.